Hello and welcome to this presentation, Exchange Future for Physical, sometimes referred to as EFP, or it's also known as Against Actual. In this example, we're going to look at a situation where we have two participants in the underlying physical market who have currently futures hedges in place and wish to coordinate between themselves the physical exchange of the goods and at the same time orchestrate via their brokers or clearing members closing out the futures contracts. And the reason they want to do this is because it allows them to overcome any issues of execution risk. That is to say, sometimes when you have a physical position and you want to offset that physical position whilst you have a futures hedge in place, it may sometimes require you to do at least two transactions, in which case by the time you do the physical trade, the futures market price may have moved, and then that may adversely affect you when you come to take off the futures position, and that can affect the outcome of the hedge. So let's look at this example then, where we have a grower who is long the physical and currently has a short futures hedge. In other presentations we explain what it means to be long of the underlying market and why you need to sell futures to hedge. Also today, suppose we have somebody who is short the physical, such as a refiner or a roaster or a miller, and they have hedged their position by going long of futures. Suppose later on the two respective parties get in touch with their individual brokers, which we refer to as broker X and broker Y. And the intention is, remember, that the two participants in the physical market wish to do the physical transaction now together and at the same time offset their futures contract. So instead of separately doing the physical trade and then separately going into the futures market and laying off their futures hedge, which can expose them to what we call execution risk, they can get their brokers to orchestrate the physical deal and the futures offsetting trade at the same time. So in this situation, before futures delivery day, at a convenient opportunity for the two underlying participants, the broker X then helps the farmer sell the commodity to the refinery and then buys a future. Now what happens, of course, is that from the refiner's perspective, they go long the physical, they take physical delivery of the underlying commodity and sell futures to the farmer. Now this is all organized via the brokers, but you can see what's happening here. The farmer will then deliver the crops in exchange for cash, so that on a net basis then the farmer has delivered the physical and closed out the future, and the refiner has, in this example, received the physical and at the same time closed out their futures contract. So just to summarize then, an exchange future for physical is a convenient way in which participants in the underlying market who may already have an existing futures position can enter into an agreement where they can do the physical transaction between themselves and at the same time orchestrate a situation where they can close out the future in a pre-arranged trade. Of course, they have to inform the exchange where the futures contract was originally conducted of their transaction, but the exchange is more than happy to facilitate this because it enables the two participants, as we've seen in this example, to benefit because it avoids execution risk, that is timely risk when it comes to doing two transactions in two different markets. There are other examples of exchange future for physical, and we're going to look at another one here. Suppose, as before, the grower is long of the physical and hedged with a short futures position today. Only this time, the refiner or the roaster or the miller or the manufacturer is short of the physical but does not have a hedge in place at the moment. But what they want to do is to, in a short while, go long of the physical and store the physical. And of course, if they're storing the physical, they may want to hedge against falling physical prices. So they need to, in that situation, when they go long of the physical, at the same time, ideally, sell futures in order to protect themselves against falling prices in the physical market. So again, what can happen is that later on, the two participants via their brokers arrange a transaction where they can do both physical legs and futures transactions at the same time. So in this example, the farmer will go short of the physical and buy futures to close out their original short futures position, and the refiner will go long of the physical and sell futures. Now, notice that the farmer will, of course, deliver the physical, and the refiner will hand over the cash in receipt of the physical. So the farmer has achieved their objective, which is to deliver the physical and close out the futures simultaneously without any execution risk. The net position as far as the refiner goes is that they have received the physical, and they're not going to use the physical for production purposes immediately. Remember, they're going to store it, and of course if they're storing, they're worried about physical prices falling. So therefore they need to have in place a short futures hedge, which of course they do because, remember, having gone long of the physical, they sold futures to the farmer, and that leaves the refiner then in a nice hedged position. Let's look at one more example of an exchange future for physical. Suppose we are a farmer or a farmers cooperative and we're long the physical but have no futures hedge in place at the moment. Notice also that the refiner is short of the physical and also has no futures hedge at the moment and wishes to, in a short while, go long of the physical, not to consume the physical but to store it. Now, later, suppose via their respective brokers, the farmers cooperative delivers the physical to the refinery, but notice on this particular occasion that the farmer cooperative buys futures, and the reason for this might be because the farmers cooperative could have committed additionally to deliver physical to other refineries and is concerned that they may not have enough of their own produce to satisfy this obligation. So what the farmers cooperative might do is to buy futures, because on a later date they may need to go into the market and acquire the physical commodity from another farmers cooperative, for example, in order to satisfy their obligation to deliver the commodity to the other refineries. So it's sensible, therefore, that the farmers cooperative buys futures in order to protect themselves against rising commodity prices. Now, if the farmers cooperative does deliver the physical to the original refiner, that means that the original refinery then goes long with the physical and they will sell futures. And what happens then is that the commodity is delivered and the cash is exchanged. And so the net position then for the farmers cooperative is that they've delivered the physical and they've covered themselves with a long futures position. And as far as the refinery goes, they have a net position where they have received the physical, and because they're going to store the physical, they need to have sold futures, which they have in this particular example.